is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the market insights for January 13th. Well, global foreign exchange reserves have been declining since the beginning of last year. The decline gathered pace in the spring as China started seeing large outflows, and the oil-producing countries began using their reserves to compensate for lower oil prices. Now, the flow has become a torrent, with China seeing a record decline in reserves in December. The decline in global foreign exchange reserves is the mirror image of quantitative easing. Instead of buying domestic bonds to inject money into their economies, central banks have to sell foreign bonds in order to drain money from their economies. The net result is that the domestic money supply of these countries shrinks, interest rates go up, and economic activity usually slows. Usually, the sale will go on until either the currency reaches what the market believes to be the appropriate level, or interest rates go high enough to tempt investors into to hold the currency. Argentina, which was the worst performing currency in 2015 on a spot basis, but achieved the best total return, was a case in point. Either that, or the country just imposes capital restrictions. Now, the shift in foreign exchange reserves is obviously good for the dollar for two reasons. One, it means there's foreign demand for dollars. The central banks will use the rising price of the dollar, in other words, the falling price of their currency, as the signal to sell dollars, which by definition means that there's upward pressure on the dollar. Secondly, the fact that the central banks are selling dollar assets, mostly one assumes bonds, should push down the price of these assets. In other words, it should raise U.S. interest rates, at least to the extent that the other foreign investors aren't as interested in holding bonds as the central banks are. In that respect, though, there's a curious point. The Fed's holding of U.S. securities in custody for foreign official accounts, the best data, or the only data we have on foreign central bank holdings of U.S. bonds, shows no major decline over the last few months. This is in sharp contrast to both the Chinese reserve data and the overall global reserve data. The question then is, what are these assets that the central banks are selling? One answer may be that they're securities held in commercial banks, such as Chinese banks abroad. In that case, the sale of these securities means a rundown in these banks' assets, which by definition has to be matched by a rundown in their liabilities, namely their loans, probably to non-U.S. enterprises. So, the emerging market borrowers who've run up huge debts denominated in dollars will have to scramble to repay them. That's another source of demand for dollars. Another possibility could be that central banks are selling euro and yen denominated assets into the ECB's quantitative easing program and then shifting the funds into dollars. In other words, the fall in global FX reserves is like the U.S. Fed's quantitative easing program being run in reverse. It's quantitative tightening, as it were. This is another of the factors likely to support the dollar this year. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.